Hello, everyone, and a very warm welcome to today's major markets update for Friday, December the 27th, 2024. I hope you all have had wonderful holidays over the last 2-3 days and that you also did well in the markets because our forecast of the correction is still very well on track. So we still believe that the correction is ongoing, that we have completed the top of a B wave, and that we're now in the starting gates of a C wave. So far, so good. So let's go straight to the charts, and we'll start with the S&P 500. This is the daily chart, and we bottomed pretty much where we thought we would bottom, somewhere around 5,800, 5,850. And then we would rally to, remember, 60.52. I think we got 60.49.75. It really doesn't get more accurate than that. Now, the B wave could always still extend a little bit higher, so we had placed the warning levels for the bulls on the chart because we didn't get exactly to 60.52. For those that have read my updates on Monday and yesterday, that was, of course, what we were looking for, right? So far, so good. And we didn't get 60.52. We could have even gone to 60.70 if this B wave decided to extend. But as you can see, we stalled out pretty much in this ideal target zone. These are the warning levels for the bears with, of course, the recent all-time high, the ultimate warning level. That would mean that this wave 5 is most likely already underway and that the wave 4 already bottomed last Friday. But today is already a good signal that the C wave lower is underway. We broke below the first and the second warning level and also closed below the second warning level. Remember, the first warning level is the blue dotted line, which was yesterday's low. That means that we've now made a lower low and a lower high. That is an initial bearish sequence. So we also closed below the second warning level, the gray dotted line. That means that we have gotten our proverbial shot across the bow. If we zoom in, the hourly chart, I don't use it that often anymore because it is a little bit more open to interpretation, because the more scribbles you have, the more likely you're going to make mistakes. Annual charts are super easy and honestly 99% of the time correct for Elliott Wave. So we have our top here in early December for wave 3, an A wave lower, /1, some might say, but I think it's an A wave because we believe this is still a corrective price action. Then a B wave higher, an A, a B, and a C. And then this B wave top was that of a, I would say, regular running flat. And then we have wave 1, A, B, C for wave 2. This is a irregular expanded flat wave 2. And then we have 3, 4, and 5 of C of A. A, B, C, and already on Monday, remember, I told you we're going to go to 60.52 because that's the equal length of A measured from wave B for wave C. Well, we got to 60.49.75. That is so accurate, it cannot get any more accurate than this. This is the accuracy of the market itself, and this is all we can ask for. We got 5 waves up, 1, 2, 3, 4, 5, classic C wave behavior. Okay, we got 3 waves lower, as you can see here. So if you would like to see that, this is then wave A, that's the bottom there. Then this 1 hour rally was wave B. And then of course the next drop was wave C. There. And then we got wave 1 up, corrective hour was wave 2, wave 3 up, corrective hour was wave 4, the few hours up for wave 5, C of B. The decline into 2 days low counts very well as 5 waves lower. If I would make this a line chart, you can see it very well. Let's see here, I'm going to do a solid line thin. So we have here the 1, the 2, the 3, the 4, and the 5. Picture perfect. Okay, I really like it. This looks really good for 5 waves lower. You can even see it here. 1, 2, 3, 4, 5. And we should now be in a bounce for this B/2. So we've completed A/1, most likely 1. If this is indeed a C wave lower, we should see, of course, 5 waves lower, just as we saw 5 waves up here. That is the modus operandum for a C wave. The MO of a C wave is 9 out of 10 times 5 waves. It can turn into a diagonal, and then diagonals can have a more 3-wave type of fashion. But for now, the decline that we've seen from yesterday's high looks very nicely as a impulse. And I'll show you that for the Nasdaq 100 as well. 1, 2, 3, 4, 5. A, B. I placed this B wave here intraday. I bought myself, and I think we can rally here to about 59.90, potentially 60.22. Okay, that is the 50 to 76.4% retrace of the decline since yesterday's high. Okay, so then we should see, of course, a wave C/3, as you can see here. And then we should see, of course, after that, potentially a wave 4. Somewhere around there. Right? We don't know yet if we're going to get 5 waves lower or not. Most likely we will. And then, of course, we're going to see the wave 5. It all depends on where exactly the B/2 wave is going to bottom, right? That's what we're looking for, something like that. So I think we completed orange wave B. We should now be in this orange wave C. And then we should get in the starting gates for this one. And then this one. So most likely the last 2 trading days of the year, December 30 and the 31, should still be bullish, in my humble opinion, and then things might start to unravel. This is, of course, all contingent, of course, on holding above this high, and of course, especially the all-time high, right? That's why we've put the warning levels for the bears on these critical levels. The first warning level is today's open, which is about equal to yesterday's low. The second warning level is, of course, yesterday's high. The green B wave can always become protracted. So then this was A. So now we have A, B, C for A. Then we have a wave B and then another wave C. So it can become very complex if it so desires. But given that we have most likely what counts very well is 5 waves lower, I'm not going to count on that, but it is possible. Okay, again, we got nice 3 waves up that suggests that this was all of the counter trend rally. It kind of retested previous support resistance levels. And now we should see this counter trend rally one more time. And then we should see our decline. And how low can this decline go? Well, we have, of course, our daily chart as parameters, but with the hourly chart, we can also get some very nice parameters. So this would then be somewhere around 5830 to about 5800. Okay, so make that 5815 plus minus 15. All depends on where exactly this C wave of the B wave is going to top. Then here we have, as you can see, 5920. Plus minus 15-ish, somewhere around there. And then we have ultimately, as you can see here, 5800 plus minus 15. Right? That is just based on standard Fibonacci-based impulse patterns, and we don't necessarily have to adhere to those. Right? We can have a very extended, just like we saw here, third wave. But we start off with what we can know, and then we'll let the market fill itself in. Remember, already in November, let me show you first the Nasdaq. So the Nasdaq, we thought we have wave A. A wave B would then ideally top, we thought, around 90,800. Well, we got 20,000, and we should now be in this wave C. So the overall pattern is still alive and well. So we still think this wave C of 4 can go here. And I really want to show the Nasdaq as a good example of why we still think we should see another wave 5, because the rally since the August low does not look complete. It just does not look like we have made 5 waves up. All right, the decline here just before, I would say, the presidential elections, or just after the presidential elections, or the presidential elections outcome was here. This doesn't look like a good 1, 2, 3, 4, 5. This looks like really much better as a extended wave 3, and then a wave 4, and then a wave 5. Okay, this is, I think, a much better Fibonacci-based impulse pattern that would adhere to this trend channel also much, much better. Okay, so this is kind of what we're gunning for. Yeah. And then we should see this wave 4 of C bottom somewhere between 18,800 and 19,000, somewhere around there. Similarly for the Nasdaq 100, also here it looks better with another leg lower to complete a wave 4 and then a wave 5. And then once again from the August low, it's very hard to say, all right, we have really clean 5 waves up. This does not look like 5 waves up yet. So also here we topped right here at the upper end of the ideal B wave target zone that we already put out last week. So far, so good. Okay. Alternative, of course, remains that the wave 4 is already completed, but that is our alternative. If anything, the Nasdaq counts better as 5 waves lower on the shorter time frame. Okay. AB 1, 2, 3, 4, 5, or you say this is all of 1, 2. Depends a little bit on how you assess it, but I think this looks still better as an A, this looks better as a B, and also here 5 waves lower. So on the Nasdaq 100, I expect a counter trend rally to about 21,600, 21,700, and then a 3, 4, and 5. If we follow a standard Fibonacci-based impulse pattern, this wave 5 would bottom somewhere around 20,450, 20,600. If we go here to the daily chart, you can see the green wave C is between 20,300 and about 20,600. So is the ideal red wave 4, 20,900, 20,300. Okay, so it matches all really well. So now the hourly chart starts to fill in with what we are expecting from the daily chart. I still expect a bounce over the next day or two, trading day or two, of course, and then lower. Okay, that's the preferred price action, with of course the warning levels for the bears still there. As I wrote in yesterday's update, I don't give any trading advice, but if one desires to short this market, then all stops should be placed at the all-time highs. That is a logical way to trade this market. I personally was in SPXX yesterday and I closed them out today. I don't want to hold anything over the weekend. And actually, as I showed you, I went long a little bit for the anticipation of the bounce and I have my stop loss level in place. Very easy. That's how I apply this to the markets. And if you can't trade those shorter terms, don't worry about it. There's plenty of opportunity left. And even from a longer term perspective, we still don't see any warning levels. We still expect that 5 waves up, and we have not seen those 5 waves up. This does not look like a completion of 5 waves higher, unless this was wave 4, but it would be very shallow and very weird to see it that way. All right. So again, the Nasdaq also suggests, no, we've not completed a nice channel surfing 5 waves up. This still looks part, in this case, of a extended diagonal, quite overlapping all ABCs, so to say, A bottomed, B topped. So I like it. So the correction is still on track. Better put, of course, the forecast of the correction is still on track, that we topped where we had to, we bottomed where we had to. Okay, so far, so good. If I would go, I believe, to my X account, I posted there a review of what we had last week compared to what we happen now. So on December 19, okay, we forecasted that we would bottom around 20,900, 21,200 for the green wave A for the Nasdaq 100, then rally to 21,510, 21,870 for green wave B, and then drop to 2,300, 2,600, right? This is from December 19. If we would zoom in, it's a little hard. There you can see December 19, A, B. We bottomed right here in this ideal green wave target zone, right? Exactly. And I'm showing this for people that are going to watch this video on YouTube to show you how exact our forecast can be. It's not always the case, but again, 70% of the time it is. And 70% of the time gives you a tremendous edge in trading the markets. Topped, and we should now be here. So this matched. So then, of course, we continue to forecast this lower until proven otherwise, which is, of course, a breakout above the all-time high. Then I question the validity of another leg lower, and that this A wave is not a wave, but all of four. It's alternative wave count. And we don't trade the alternatives, we trade the preferred. Okay, so far so good. And if I go even back further in time, in November, already in November, we had the idea that we would top out somewhere around the 123.6 to 138.2 at around 21,510 to about 20,900. Well, we got a little bit over 22,000, an extended wave C. This was not a 3 wave, but a wave C. Right? Remember, we were not entirely certain yet if we would see a 4 and a 5. But this is, of course, the preferred wave count, and it's feeling it really nice. This is the power of the Elliott Wave. It gives tremendous foresight. Then we go forward to the less easy to interpret indexes. Again, Nasdaq 100, we're looking for a bounce, 21,600, 21,700-ish. And from there, we should see another decline, contingent on holding at least above yesterday's high, which is about 21,850, and especially holding above the all-time high at 22,133. Same, of course, for the SP 500. We expect a bounce to about 6,000, 6,010, plus minus 10. That should remain under 6,050. Yesterday's high, 49.75 to be exact, and especially hold below 6,100, 60.99 something. Okay, that's what we're expecting. So you have very clean, clear parameters to go by. We top out here, and if we then break below today's low at about 59.30, I believe it is, yeah, 32.95, then I'm pretty certain we are on our way to 58.15, etc. And again, 5,800 plus or minus 15, 5,800 plus or minus 15, as you can see here, matches very well with where this ideal C wave of the 4 wave should bottom. The 4th wave ideally between 57.36, 58.12. Okay, so if we get 5,800 plus or minus 15, it is gespotsons on, my dear friends. It does not get more accurate. If we can nail this, please send my application for the Nobel Prize to Norway. Anyways, moving on to the less clear indexes. The Dow Jones can have already put in its larger 5th wave top. It is very hard to interpret the exact labeling for the price section between April and August. This is one way, 3, 4, 3, 4, 1, 2, 3, 4, 5. And the other way is that we had a complex wave 4 of a irregular running flat, A, B, C, and that we're still in this 4th wave of a ending diagonal. Okay, it would match, of course, better with the Nasdaq and the SP 500, but we don't necessarily have to have the same wave count. As we all know, last week we pretty much had completion of the worst losing trades since 1974. And that we definitely didn't see with technology, which just topped out, right? Technology was here and Dow Jones was there. Quite a difference. IWM also can still do a 3, 4, 5. As you can see here, 1, 2, 3, 4, 5. I would say once we complete this C wave lower, even for a decent bounce, all right, if we would go back up to about 234, potentially about 238 from about 210 on the IWM, that's a massive gain. Semiconductors, honestly, I don't really know what kind of soup to make out of this mess. It is a tremendous corrective looking mess. The all-time high was in July. We haven't bested, so I still don't prefer this index. There's some individual stocks in there that are still working well, but you can see this looks like more like a rolling over type of index. To be determined, so this is a low confidence, low accuracy wave count because of the extreme overlapping price action. Down, up, down, up, down, up, down, up, down, up, down, up. ugh. Nothing like what we saw here in the early part of the year or even here in July. This is trending down hard. Trending up good, trending down, trending up. Yuck. Sorry, it is what it is. Okay, so this is a low confidence wave count. And IWM already covered, so we've covered all the indexes. This is the AD line. It's still not looking happy. And as you can see, it is in a downtrend. It needs to break at least above this downtrend line to tell us that the correction is over. And then we're going to monitor it for long-time negative divergence to tell us if we are indeed approaching a massive market top, because we need to see month-long negative divergence at a minimum to tell us that the market is going to usher in a very large correction. But as we know from the 50s and 60s, such divergence can last for 10 years. Now, I don't think it's going to last that long, but that's just me thinking ahead, and we'll have to just track it with the price action. But this is something to really keep in mind. Okay, so as you can see, the AD line has some catching up to do, and we'll track it because we already had slight divergence here between late November and early December, and now we are in this correction. It took a while for it to set up, but the correction has come. It tends to always happen. Eventually it will come. Though the divergence, of course, can be erased, but you always get the correction. How we're doing with the buy-sell indicator, it's bottoming out, zero signs of a top being in place. And remember, this bottoming and out here can last for a while. Okay, as you can see here as well, can last for a while. It doesn't mean, oh, we've bottomed out, we're instantly going to rally. No, it can last for weeks. How we're doing on the McClellan oscillator, it is negative. It spiked just to positive yesterday, and I think it is very prudent to start looking for positive divergence. Okay, oftentimes when we get such low readings, we'll get positive divergence. So that's what we're also going to look for. And as such, the summation index is still on a sell. All right, extreme oversold, so at some point the tide will turn and it will eventually become extreme overbought. But this is a very good indicator as well, especially if we go below minus 500 or below minus 1,000. We're going to go deep into buy, baby, buy type of levels. Okay, not there yet, but this is also we try to track to match it with our wave count that we have on the charts. So that's really where we are at today. I wish you all a wonderful weekend. We'll be back on Monday. Let's see if there's going to be an update on Tuesday. It all depends a little bit on how busy I am going to be on New Year's Eve with a lot of family activities. I'll try to. If not, it's going to be a very brief written update, just as we did yesterday and on Monday. If you have any questions, please let me know. I'm here to help. Take care, trade safe, and we'll see you all at the last week of the year. Bye.